All of the major Canadian Big Six banks now have reported their results for Q2 2025, and I want to cover the details here and the most important takeaways from those reports. I want to start with some sector-wide trends that are pretty easily identifiable. Number one, the elevated loan loss provisions. And this is one clear trend that extends pretty much across the banks this quarter. There was a notable increase in provisions for credit losses. And these are provisions that are essentially financial cushions, right? They're funds that the bank set aside to absorb potential loan defaults. And what we saw with these reports was there is a lot of ongoing economic uncertainty, and the banks are stepping back and taking an even more cautious stance than they have been recently. And this is significant because it kind of serves as a bit of a barometer about how our country's largest financial institutions perceive future economic risks. Now, in practical terms, this affects both investors and borrowers. Specifically for investors, the higher provisions that is typically going to weigh on profits in the short term. It can also signal prudent risk management that protects the banks over the long term. For borrowers, that could lead to tighter credit conditions. The banks are becoming more selective in lending to avoid adding risky loans to their portfolios. Now, I also want to speak about the timing of these provisions. And these increases, they come during concerns as they're growing over a potential economic slowdown. We've heard a lot about that recently. And the fact that the banks are setting aside these billions of dollars, even on performing loans, and that's critical here, that suggests that they're not just reacting to sort of current defaults, but they're also anticipating worsening credit quality in the months ahead. It is forward-looking. It's a defensive move that just shows how seriously the financial institutions are taking the current uncertainty. Now, the second thing I want to talk about, a big part of banking here in Canada is the capital markets, and that performance varied quite a bit across the different banks. It was a very mixed quarter. That again is a reflection of sort of the uneven impact of market volatility on different institutions. As an example, CIBC, National Bank, they both delivered strong performances in this area. We see CIBC's capital market earnings rising 20%. That's thanks to increased trading activity and client demand. Now, on the flip side, we saw RBC with a 5% decline in capital markets, and that was due to weaker fixed income trading, fewer mergers and acquisitions that weighed on their results. So what this quarter seems to show is that CIBC and National Bank, their strong showings, they suggest that they were better positioned to capitalize on the market volatility that we've seen recently, and their results also indicate there's certain pockets of financial activity. So think of things like commodities, currency tradings, those areas themselves might still be thriving. Now, the third takeaway, dividend increases. And even with all of the economic uncertainty that we're seeing, even with these higher loan loss provisions, 5 out of our big 6 banks still went ahead and raised their dividends in Q2. And that's a pretty strong signal that they feel good about where they stand financially. RBC bumped up its dividends, Scotia Bank, BMO, National Bank, CIBC, they all did as well. The only bank that kept its dividend unchanged was TD. Now, I would say when you look at these increases, they are a sign of confidence, right? Canadian banks were known for their stability, and this kind of move just sort of helps to reassure investors, especially those who count on steady income from their dividends. Couple of points here. When we see the banks bump up their payouts while also setting aside more money for potential loan losses, they're basically telling us that they are confident that they can handle whatever comes their way. And lastly, on this topic, it also shows the banks are on solid footing. Regulatory capital levels are strong. We're going to talk about more on that in just a minute. So they have room to both reward shareholders and stay cautious. Now, I want to move on to each of the 6 banks' individual bank reports. I want to start with TD Bank. So TD reported a large net income in Q2, largely because of the sale of its remaining stake in the US-based Charles Schwab organization. So that one-time gain there, that boosted their earnings quite a bit. But even when you take that out, even when you exclude that, the bank still delivered a strong quarter on an adjusted basis. Earnings per share came in ahead of market estimates. We look at the actual metrics. Earnings in Q2, $11.1 billion. That's $6.27 a share. That compares with earnings last year of $2.6 billion, $1.35 a share. Adjusted earnings, $1.97. That beat analysts' expectations of $1.78. They declared a dividend of 1.05 cents per share. Now, the key takeaways as far as TD is concerned, again, the majority of that profit came from the gain on their share of Charles Schwab down in the US. The adjusted earnings did beat expectations. That's a positive. Total provisions for credit losses, they rose to $1.34 billion. That's up from $1.07 billion a year ago. ago, 395 million of that was set aside for performing loans. Now, TD is reducing its workforce by 2% as a part of sort of a broader cost control. Operational adjustments, the vast majority of that will come through attrition, they say. And the bank's capital position, that remains strong, CET1 ratio of 14.9%. Now, the Bank of Nova Scotia, they reported some mixed results in the second quarter of this year. Its Canadian banking business hit a bit of a rough patch. We saw profits slipping because the bank had to set aside more money for those potential loan losses. On a positive note, though, other areas like international banking and wealth management, they held up pretty well and actually grew their earnings. The bank said it's also sticking to its plan of focusing more on North America, pulling back on some of the international markets to try and streamline their operations there. So even with a few bumps this quarter, their balance sheet did stay pretty strong. Capital levels were solid, and it showed confidence by raising its dividend and announcing a plan to buy back some shares. That will tell us as investors that it's all in pretty good shape financially. The actual metrics, earnings Q2 2025 were $2.03 billion, $1.48 per share. That's down from earnings a year ago of $2.09 billion or $1.57 a share. Adjusted earnings per share, $1.52. Now that came in below analysts' expectations of $1.57. They did declare a dividend of $1.10 per share. Now, some of my key takeaways here is we noticed that the net income, it did slip 3% year over year. That was impacted primarily, they say, by their higher credit provisions. The bank set aside $1.4 billion in those provisions for credit losses. That was more than the analysts were actually expecting. Now, Canadian banking profits, they fell 31%, and they cite U.S. tariffs and economic stress that weighed on those results here. Some other divisions, especially international wealth management, they did post stronger earnings. CET1 ratio came in at 13.2%. Now, as I mentioned, Scotia Bank did raise its dividend by 4% up to $1.10 per share. And they did announce plans also to repurchase 20 million shares. Now I want to move on to Bank of Montreal. And BMO did turn in a solid performance in Q2 2025. Both net income and adjusted earnings per share moved higher compared with last year. The bank did also get a lift from its wealth management and U.S. operations, which performed well. That was helped in part by exchange rates working in its favor. And even with that increase in provisions for potential loan losses, BMO's wide range of business lines, they say tight control on expenses helped keep their earnings on track. It also raised its quarterly dividend, and that is a move that again sort of signals some confidence in its outlook. Earnings in Q2 came in at $1.96 billion. That's $2.50 per share. That's up from Q2 2024 earnings of $1.87 billion or $2.36 per share. Adjusted earnings per share came in at $2.62. That beat analysts' expectations, which were $2.55 per share. They did declare a dividend of $1.63 per share, up 5%. My key takeaways for BMO, it was nice to see that second quarter profit, which beat analyst expectations. The bank did set aside $1.05 billion in those provisions for credit losses. That's higher than what the analysts were expected. Total revenue, that was up 9% in the quarter. That came in at $8.68 billion. Expenses increased as well, up to $5.02 billion. So the bank does continue to show that financial strength, has a CET1 ratio of 13.5, and that's well above the regulatory minimums of 11.5. I'll note that BMO did raise its quarterly dividend by 4 cents. That's up 3% to $1.63 per share. Next on the list here is National Bank, and they had a pretty strong showing in Q2, Financial Markets Division leading the way. We also saw a nice increase in trading activity, and that was fueled by ongoing market volatility that helped boost their earnings in that segment. The bank also saw a revenue lift from its recent acquisition of Canadian Western Bank, which started to show up now in its results. Now, like the other banks, provisions for credit losses, they were higher this quarter. That's a reflection of both more caution, like the other banks are showing. Also, there is some impact there, pretty significant impact from its integration of Canadian Western. The bank ended the quarter with a solid capital position, raised its dividend, and that would signal some confidence in its financial strength. The numbers themselves, Q2 earnings were at $896 million or $2.17 per share. That's down from earnings in Q2 a year ago of $906 million or $2.54 a share. Adjusted earnings per share, $2.85, and that beat analysts' expectations, which were $2.40 a share. CET ratio, 13.4. So the key takeaways for National Bank here, they did cite strong market revenues, and that is supported by very strong trading performance. Their provision for credit losses, they were $545 million in the quarter. That includes $230 million that was tied to the Canadian Western Bank acquisition. Total revenues up 33%. $3.65 billion. Expenses also climbed 32% to $1.94 billion, and you can see the integration of Canadian Western into those operations there. Adjusted earnings, they beat expectations by a nice, healthy margin. The bank did raise its dividend by 4 cents. That's 3.4% overall to $1.18 per share. Now, Canadian Imperial Bank of Commerce, CIBC, is next on the list here. They had a pretty strong quarter. Net income was up 15% when you compare it to last year. And again, they say that performance came across a lot of different sectors. Capital markets stood out though, and they said thanks to increased trading activity during this volatile stretch in the markets. Commercial banking, wealth management, they also contributed, helping to drive the overall earnings higher. Now, the bank did increase its loan loss provisions like the others, but the total was below what the analysts had expected. So from the actual reporting numbers, Q2 earnings, $2 billion on the nose. That's $2.04 per share. Adjusted earnings, $2.05 a share. That beat the analysts' expectations of $1.90 per share. CET capital ratio is 13.4%. And they declared a dividend of 97 cents a share. So the key takeaways here is that 15% rise in net income year over year. And what they're citing is that is across all of the major business lines. So that shows some depth to the operation there. Capital market earnings were up 20%. And again, that was boosted by that sort of active trading and the market volatility, which helps in certain instances. The bank did set aside $605 million for provisions for credit losses. That came in below what the analysts were expecting. The total revenue, that was up 14% to $7 billion. Expenses were up 9%, largely due to performance-based compensation. The bank did raise its quarterly dividend by 4 cents to 97 cents a share. Now, Royal Bank, they posted a pretty solid year-over-year growth in Q2. The bank says that they saw strong results in personal banking, wealth management, and insurance, and that helped lift the overall earnings picture. Even with that growth, though, RBC fell short of analysts' expectations on a per-share basis, the first time that they have missed now in 2 years. Now, this miss came down to two key pressure points. One, those higher PCLs we've been talking so much about today, and also a 5% drop in their capital markets income. That was hit by slower trading in fixed income and a quieter environment for M&A deals, especially in the U.S. The bank did raise its dividend. It announced plans regarding a share buyback program. So the metrics in this quarter's release, the earnings were $4.39 billion for the quarter, $3.02 per share. Earnings in Q2 2024 were $3.95 billion or $2.74 per share. Adjusted EPS this time around, $3.12. That came in below analysts' expectations of $3.20 per share. Now, the bank held a CET1 capital ratio of 13.7%. Declared a dividend of $1.54 per share. Key takeaways from this report: net income, that did rise 11%. The adjusted earnings per share, they did miss analysts' expectations. Again, that marked the first time in 8 quarters that they have missed those. Provisions for credit losses, they climbed to $1.42 billion, and that is well above last year's $920 million. So we can see what an impact that is having there. Capital markets income, that fell 5%, and they're citing weaker trading and lower M&A activity. The bank did hold a CET1 capital ratio of 13.7%. And it also did raise its dividend by 6 cents and announced plans to buy back 35 million new shares. That brings you all up to date on our Canadian banks. As always, I say thank you so much for watching, and we'll see you in the next video.